So let's talk about absolute and relative returns. Join me, guys. Hello, folks. So welcome to The Way I See It, which is my podcast on economy, personal finance, money, and how they all intersect and what we can learn from it. This week, I want to talk about returns. Absolute return, relative return, what do they mean, and how can we use them in our personal finance? This week, I was speaking to a friend of mine. We were like going over his portfolio. He has a portfolio of Nigerian equities, and he was doing a review. And he said he had done, by his calculation, about 27% all in from January till December 2020. So he had done in percentage terms, about 27% return. That was pretty good, considering what we all went through in 2020 with the COVID and all that. And so I did ask him, I said, hey, what about on a relative term? What do you think you did on a relative term? And then he said, well, what is that? And I said, okay, relatively, the Nigerian stock market as an index, i.e., all the stocks listed on the stock markets, did about 50%. So if you compare your personal portfolio with the Nigerian stock market portfolio, then your portfolio underperformed the entire average, i.e. the index. So on an absolute basis, you did the 27%, which is true. But on a relative basis, when you compare yourself to the index, you did a return below 50%. So his argument was, well, I beat inflation. Inflation in Nigeria is about 13, 15, and my return beat inflation. So I got a real rate of return, and I should not compare to the index and all that. Okay, let's say that's a fair point, but that's also a good time to talk about these two and try to see how we can use them. So, like I said, the absolute return is easy. It's the return that you make on a portfolio over time. You know, it could be a group of portfolio or in a market or in a geographical area, just what you make. So, like in his instance, his absolute return is 27%. Relative is now the excess that you are making above that average. So, if the stock market in Nigeria returned 50%, and believe it or not, that was the highest return in the entire world in 2020. If the market did 50%, that means my friend would have had to do 50% plus to then beat the market. And that return in excess of that market is what in investment we call the alpha. So your return, when you say you are chasing alpha, it means that you are using a strategy to beat the relative or to beat the index or the average of the stocks or the commodities or the asset classes in that environment or in that geographical area or in that market. You basically want to beat the index. So you are chasing alpha. That's the whole idea. Now, the point is this. When you are investing, it's very important that you invest according to a strategy that you have laid out before you even start to buy or sell anything. If my friend's objective was to have a real rate of return, i.e., he wants to, at the end of the investment period, which is going to be December 2020, he wants to have a return that has grown larger than the rate of inflation. If that was his return, if that was his objective ab initio, then he's met his objective, irrespective of the return on the Nigerian stock market, which was about 50. But if his return was to chase alpha, i.e., he wants to beat the average of the market, then you can see he did not achieve that. So your objective should determine the asset classes that you should invest in. If you are a retiree and you're about 72 years old, then the assets that you buy into your portfolio from your lifelong savings would differ from a 24-year-old that has just gone into the labor force and has about 40 or 50 years to literally invest and make mistakes and grow his money. The two objectives are different. Hence, the asset classes that the two objectives will create to meet their would also be different. So in the retiree's case, of course, it's going to be bulk in bonds. For the younger worker, it's going to be bulk equities. Different objectives, different asset classes. Which then says that when we then look at the performance of these two asset classes or these two portfolios over time, we cannot compare portfolio A, let's say that's the retiree, with portfolio B, which is a younger gentleman. No, because they both have different objectives. So because they have different objectives, the absolute returns, we cannot compare both of them, even though numerically one portfolio might have a higher return than the other portfolio. This is why we should be very careful about saying, I made 14, my friend made 26. I want to be like my friend, hence I'm going to invest in this asset class so I can generate alpha and then my portfolio can beat the average. No. If your objectives are not the same, then your asset class cannot be the same. And I have a very, very good example I can use to just walk us through this. So I lead my hands, or I got a copy of a nice visual of the returns on asset classes from 2011 all the way to 2020. I tried to put it up on the Twitter handle, Fin Plan Carlo Archer One. I'll try to put up the infographic there so you can follow. But let's assume that in 2015, right, 2015, we had an investor that says, hey, I am going to make sure I invest in the fastest growing asset class going forward. What he's trying to say is that for every year, I will put money in the asset class that did the best for the preceding year. That's going to be my strategy. So if stocks did well last year, I will invest in stocks this year. I want to ride that moving train. Let's use this as an example and see what would have happened to that portfolio if he just tried to chase returns as a whole. So in 2015, the best performing stocks were REITs. REITs are real estate investment trusts. So they invest in the basket of commodities, in the basket of real estate, and then they pay you high dividends. So in 2015, REITs did about 2.4. That was a bad year, 2015, for investing because the highest return was about 2.4. Large caps did about 1.3. So in 2015, the best return is going to be REITs. So he says, okay, I'm going to invest in REITs in 2016 because preceding year they did well. So I'm going to invest in 2016 in REITs. So he puts the money in 2016 in REITs, and his return is going to be about 8.6, which is not bad. The problem is that the best performing return that year is going to be small caps, with 26%. So you can see if he simply bought the best performing stock for last year because he was chasing alpha, he's failed because in the year 2016, he's not been in the fastest growing asset class, which is going to be small caps. So he does the same thing all over again. He says, okay, 2017, I will now go buy small caps because I want to take advantage of that moving train. If he does that, small caps would have returned 13%, which again is not bad. But emerging markets would have returned 37%. So you can see how he's missed again on the train. He says the same thing. Okay, in 2018, I'm going to buy emerging markets so I can take advantage of the moving train and generate alpha. He does that, and emerging markets absolutely crash in 2018. They go to about negative 15 for 2018. What's the best performing asset class 2018? Cash. Just simply holding cash in the bank would have been the best investment strategy in 2018. So of course, he didn't hold any cash. He invested in emerging markets, so he lost a lot of money. And remember, every year he is buying and selling, he's paying transaction cost. What about 2019? So now he says, okay, I'm going to buy cash because cash is the best way to invest. So he puts his money in cash. What happened in 2019? Cash is the worst performer at 2%. Large caps basically are returning 31% in 2019. So eventually 2019 says, okay, I'm going to put money in 2020 in large caps. And yes, he does. In 2020, does score because 2020 large caps are also the best performing asset classes. So in 2 years, they were the best in 2019, 2020. So he then got 1 year correct. What would have happened if this guy has simply invested for the whole 10 years in, say, large caps? He would have had about a 13.8 return. Just if he didn't move around chasing those hot sectors, but just simply stayed in large caps for the entire 10 years, he would have made about 13.8. If he did small caps, he would have made about 11%. Yeah, if he did REITs, about 8.7. So this is just showing that, listen, if you try to chase assets, you are taking a higher amount of risk because past performance is not a guarantee of future performance. The success is not in the DNA. If you pass today, you still have to go invest to make a return for today. So you cannot assume and say the markets or this asset class will always make a profit. Hence, if you are chasing relative return, which is you're chasing an excess return, you are going to take a higher amount of risk because you cannot simply know what will happen year in, year out. But then again, like we've already alluded to, because it is risky does not mean we should simply invest in just one asset class and then hope for the best. We can diversify. We can be overweight in the main asset class that corresponds with our objective. Then we can buy another asset class to give ourselves an alternate objective. So, for instance, take the retiree. Because he's 74 and is retiring and he cannot take any risk, he can do 70% of his portfolio in annuities, in safe government bonds, in corporate bonds. He can do very, very safe investments that pay him a guaranteed rate of return. Then he can take 5 and 10% and invest in equities, large caps, or dividend equities that pay him also a return back. So that way he's overweight in his main objective, but he also has some little portfolio also put in growth assets that will also give him that kick. The main thing is this, the summary of this talk is this: when you are investing, invest with your plan and let your asset that you're going to buy be driven from your plan. Do not chase relative return because it simply pays more. Do not compare your portfolio returns with someone else because you may have different objectives. Absolute returns have to be compared with relative returns because you want to see at least where you stand irrespective of your strategy. But when you see it, you should just know it. You shouldn't then go invest and chase the next hot thing. Transaction costs are a major part of portfolio returns. If you can avoid paying transaction costs on buying and selling and churning your portfolio, that's going to be a real better deal for you. So I'm just going to stop there. Like we said, we tried to summarize on absolute, relative, and how you should go and invest with your objective as the primary driver of how you want to buy your assets. All right, guys, thank you so much. Keep following the Twitter handle, Finplan Kaluaja. Subscribe and share this podcast with your friend. I'll appreciate it. We're also on YouTube, just by name Kaluaja, where we share the webinars that we do every month. So keep sharing, guys, and stay safe. I will see you guys next week. Thank you.